Welcome back to FT Markets. Behind every silver lining, there's a cloud. The price of oil has fallen some 35% over the last few months. Brent crude is now below $70 a barrel. That's obviously great news for many people, but it's also meant losses for people investing in the shares of oil majors, and it's also meant trouble for high-yield bonds issued by smaller oil producers. Who exactly is making money and losing money out of this remarkable shift in the oil price? With me now to discuss this are two of our reporters who are at the sharp end of this, Gregory Meyer and Stephen Foley. Thanks, both of you, for joining me. Thanks. Stephen, let's start off. Who has managed to make money out of this in the trend following community?
Yeah, well, let's start with the silver lining, right? And it's a very big one in the trend following hedge funds. That's the CTAs, the managed futures sector. Actually, November was the best month for 12 years, the best month since June 2002, according to the New Edge index. And
so at no point in 08, with all the very dramatic trends that were around to be followed there, did they do as well as they did last month?
Very good period for CTAs, 2008 as well. Slightly a trick of the calendar here, right? Because of the way things panned out in November with the OPEC non-action at the end of the month, adding one final leg down for a trend that had been building and building and building for several months now. And that's exactly what these funds want, you know, a trend that starts slowly enough for them to get in and then accelerates. And they made probably on average almost 6% in a single month.
Okay, so that is a silver lining. Do they presumably all still have that trade on? They're still betting on it to continue?
Well, it's there's certainly starting to be a very wide difference between different types of investors in oil now. I think Greg knows some of the stats on the balance of positions in hedge funds. I think the trend followers are going to follow this for a little while longer.
Okay, and now Greg, talking of trends, how far could this go on? Are people making bets that it could go even lower?
Some are. I mean, on net, the hedge funds, the managed money players are they're long crude. They think they're betting on a price rise.
Really?
If you look at excuse me, the latest data, which predates the OPEC meeting. So we'll see how positions may have turned after that meeting on November 27th.
So somebody has lost money out of the OPEC meeting. Clearly,
yes. But that data also, I think, masks that data masks some of the individual types of investors or speculators in the oil market. I mean, there are hedge funds who, from what I hear, are many of them have been quite short. They've been bearish for months now. Doesn't mean they necessarily made money based on the way that they structured their trades, but on balance probably did. But then that also has asset managers who, are still hanging on to this theory that commodities are a good bet to hedge against inflation and bet on long-term global growth, and they're kind of permanent longs in the market. So they for sure have suffered with this oil fall.
So that implies that there's still money out there that could exit this market, that it could push the market lower. I guess that raises the question: how low can we go?
Most analysts don't believe that we could go that much further, but I mean, interestingly, we've seen some bets in the futures market on oil dropping below $40 or even $35 a barrel. That's against the U.S. WTI contract in this case. There's been a pretty rapid growth in the number of put options that cash out below those levels. So someone's taking a punt and paying a relatively small premium on a true utter collapse in oil prices in the next year.
Wow. So $35 is a level apart from a few months in the crisis that we haven't seen in over a decade, right?
In several years, indeed.
So is anybody positioned to take advantage of that kind of a scenario, Stephen, that you're aware of? I mean, if you have oil go down to those levels, then the joke about there being a cloud behind of a silver lining really does become very real indeed. That creates problems for high yield bonds, for example.
Well, absolutely. I mean, that's a catastrophe for the US shale producers for sure. As Greg says, these are lottery tickets effectively. So this is not a market consensus. Let's not get carried away. I think the hedge funds are starting to see, though, in the oil price debate, opportunities for shifts in the market for pricing differentials that start to give them some opportunity. So this is money that can hop around. And I think one of the things they're very excited about is the bifurcation in the high yield market between the oil bonds and the rest. There's been a lot of index money that's been buying high yield as a whole. A lot of people who are in high yield as an asset class, but for the individual bond pickers, this could be a very good season.
They could continue to short the oil while going along the rest of the sector, that kind of thing.
And digging down in company by company as well. There's lots of opportunity there too.
Now, in terms of where the money is, there's obviously lots of different ways in which speculative money comes into oil. Haven't we seen various specialist commodity hedge funds actually exit the market of late, Greg? And also, at one point, there was a great vogue for passive index following futures funds just staying long, permanently long, different commodity classes. Is money exiting from those as well?
We have, on the hedge fund side, we have seen several commodity specialist hedge funds shut down in the past couple of years, I would say. The most recent being a commodity hedge fund run inside of Brevan Howard, the hedge fund operator. But interestingly, a lot of the prior closures were really, I think, due to hedge funds just not being able to make any money because oil was just not going anywhere. There was no volatility, and these guys need prices to move to, put their capital at risk and make or potentially lose money. So it'll be interesting to see now that volatility has returned to some degree in oil, how these hedge funds do, because this is really the time for them to prove their mettle as smart traders. And on the passive side, yes, there have definitely been some outflows. It's still quite sticky money. CalPERS, for example, has a small allocation that tracks the S&P GSCI commodity index. They have not announced any changes to that allocation. It's at the low end of the range, but they're not getting out. And in fact, the portfolio manager in charge of that several months ago said, he still believes in commodities, but they were just sort of underweight at the moment.
Okay, so even though the hedge funds were net long entering into the OPEC meeting last week, you still don't have a great sense that there is a lot more money that could be poised to exit the oil complex. There's no great sense there's a lot.
Well, I think it was hedge funds and asset managers. So it was both the long shorts and the longs. So no, I think there is potentially long money that could be poised to exit the market.
And finally, could I just ask Stephen, back again to the critical question of exactly how people are positioned, because if people are taken by surprise, this can cause dislocations in the market, even if it's economically a good thing. Are people covering themselves against the risk of a real calamitous further fall in the oil price? Are contrarians now beginning to place bets on a rebound? What is the pain trade for fund managers from here on out?
I'm not sure that there's a settled consensus at this point. I think people are nervous about getting back into oil at this point. One of the open questions is the question of demand and how much of this tumble has been a signifier of weakening economic demand. And following the consequences of that through in the early months of next year is the wider question for the hedge fund complex, is just how close are we to a sharp global slowdown, and will it start to infect the US and the wider US economic prospects and stock market?
Okay, Steve and Greg, thank you very much indeed. I hope that was a useful conversation. Broadly speaking, so far, no, this hasn't had too many clouds behind the silver lining, with the very significant exception of the concerns about the high yield bond market. It also sounds as though some people have actually managed to make some money from it. Obviously, a lot depends on where the oil price goes next.